Hi, this is Dan in the Master Trader Green Trading Room, and we're talking about a couple of post-earnings volatility trades that we have done here, one today, one yesterday, that we're going to review. But let me just generally first give you a few concepts on how Master Trader approaches trading volatility into and through earnings announcements. When companies have their posted earnings date, everyone knows about them, volatility skyrockets into the earnings event because it's an unknown number, it's an unknown outcome. So both the calls and the puts spike in volatility, get very expensive, and there's different ways to trade earnings trades, both with stock and option. We do like trading into earnings if we have a compelling pattern, but we just do a swing trade because we don't personally like taking the unknown risk of which way the stock's going to gap up or down. It's a gamble we personally choose not to make, but we teach others how to do it if that's something that fits their trading plan. For example, many other traders believe that volatility is always overpriced. So into earnings, their strategy is to short options, calls and puts, spreads, straddles, strangles, just short options because they're banking on the actual move being less than the expected move, which is priced in by the options. And you can just look right at your option quote screen. I use Thinkorswim, and it's right there in whatever expiration cycle you're looking at. It says the expected move up or down by expiration is X dollars. Netflix announced earnings yesterday. Their expected move was, I think, $33 or $36, I forget. So at this huge open, all of the folks who shorted the out-of-the-money call spreads were holding losing positions. Depending on how they managed that at the open, this contraction would have made them profitable. Again, depending on which ones they did, what strategy they did, was it a strangle, was it shorting put spreads, call spreads, whatever. Our strategy at Master Trader on selling options is to wait for the announcement. Step one. That was yesterday, pre-market. This is my pre-market, dotted lines here, 15-minute chart, upper left, and we're waiting for a compelling pattern. And then we take one side of it. Volatility remains high, particularly for the morning session, a couple of hours. And then it drops off fairly rapidly depending on which direction the stock is moving. I think this gapped up the 35 bucks or so. I don't know what it's going to do. All I'm looking at is pre-market. You had a nice green engulfing reversal bar right here. This could have ripped up through 390. Or it could have done what it did, which was the following. It then went sideways into the 930 market open, closing at these pre-market lows. Then it immediately got sold into. Depending on how aggressive you wanted to enter this, because it gapped to a major resistance on the daily chart, it was at resistance on the weekly chart. We then use this intraday, and our bias is down based on this pre-market action and the daily resistance. We told our subscribers, again, depending on your aggressiveness, 5, 10, 15-minute low, short out-of-the-money call spreads. I think at the time I was looking at the 400s, shorting the 400 calls, buying the 410 calls. This was yesterday, which was a Wednesday, so they would just be 3 days to expiration. And I think the midpoint when I was looking at it was like $1.09, I think. So you could have sold that bear call spread, which as long as this closes below $400 by Friday, if you did a 10 lot, for example, that would have been $1,090 that you keep and the stock was, the short strike price was $20 out of the money. That's how we use the charts and short inflated volatility after earnings announcements with the charts. Here's another example we did, or I did today. Philip Morris, Papa Mike, had earnings. On this one, this is what we call a professional gap breakout. Look at this gap today. So that's step one. You have a bullish gap. That's the daily. My weekly is a huge W retest pattern with a wide range breakout bar through this resistance, through that resistance, and we have very little congestion to the left on the longer time frames, which suggests a bigger move. I watched the market open. It sold off a little bit here right into the market open. I'm sitting on my hands doing nothing. It immediately engulfed that and started to break out. Over the 15-minute high, I wanted to short the $80 puts for this Friday, but it was too spready. Or I'm sorry, maybe it was the 85s. Whichever strike I was looking at, they were too spready. Yeah, I think it was the 85s. So what I did instead was I went out to the November expiration and I sold these naked $80 puts based on this breakout pattern, major support here on the daily, on the weekly. So as long as this closes above 80 bucks, even though my stop is going to be way the heck under this bar, under 81, 82, I'm closing the position. Then the premium I received is full profit. So that's it. That's a quick summary of how Master Trader trades volatility on earnings stocks after the announcement. Feel free to check us out in the green room. We have a 3-day free trial, mastertrader.com/green trial. Don't forget to subscribe to our YouTube channel to continue to receive incredible information on investing and trading in the markets. Good trading, everyone.